Good morning, it's Jeffrey Cohen. It's Wednesday, November 30. It is such a busy day today. Oh my gosh. We're going to talk about the markets. We're going to talk about our model run. We're going to talk about our new brochure and our formal release of our new services, our new managed accounts. We have so much to talk about. We also are watching as Corbis is making a run in pre-market. Now, as you know, I have been a bullish supporter of Corbis for many months. Actually, it's going on years now, and so it's always fun when you see a big move. And so, unfortunately for us, we can really only sell once. We can't really play the stock because we bought it over a long period of time, and if you sell it, then you have to wait 31 days to buy it back in order to keep the tax loss. Otherwise, it's considered a wash sale, and you lose the tax benefit. So let's start. So there was some cool data that came out. It's ADP, the payroll people, and they talk about jobs. So what did they say? By the way, Fed Chair Powell will be talking today at 1:30 Eastern. So he's going to be talking about some of this stuff. So the most important thing is private sector employment increased by 127,000 jobs in November, which isn't that much, right? And annual pay was up 7.6%. Now, so fewer jobs, higher pay. Well, if you're one of the people with the job, you love it. But that's interesting. So, turning points suggest that Federal Reserve tightening is having an impact on job creation and pay gains. And companies are changing their behavior. They're not in hyper replacement mode. They're not struggling to find people. Fewer people are quitting and less is happening. And so job creation slowed, led by construction and other rate-sensitive sectors, which makes sense. Healthcare and hospitality, customer-facing, COVID's over for the most part, except in China. And it's so interesting. So manufacturing lost 100,000 jobs. So those are good jobs too. So we're losing manufacturing jobs. We're losing a little in construction, but we're really losing in manufacturing. We're also losing in professional or business services, us, financial activities, us. And one of the reasons is as interest rates go up, there's just less borrowing. So I can tell you a little anecdote. I don't know that, well, this actually matters. Actually, this matters a lot. Small establishments, us, down 51,000 jobs. And medium establishments, we're up 250,000 jobs. And large establishments are down 68,000 jobs. So big companies are starting to do layoffs. Makes sense. I don't know why they're saying that pay gains moderated, because it doesn't make sense to me. If you stayed in your job, you got a 7.6% raise. If you changed jobs, you made 15% more. So there's still a lot of inflation. Leisure and hospitality, which is one of the hot industries, went up 11%. So I'm not sure. I think this is hot data. I think this is going to be seen as hot data. And what's interesting is the people moving from professional services or like banking jobs to serving tacos, there's a decline in the wealth of the people working. And I don't care if a taco server now makes $14 an hour versus $12.50. You still move from financial services to hospitality. You're working in a hospital, in a hotel, you're working in a restaurant, an amusement park, whatever. It's different. So that's interesting to me. This is not bullish on our economy. This is bearish on the economy. So that's kind of fact number one. There was another that came out yesterday, and I promised you I would read it, and it's so dense right now that I'm struggling. But this is maybe even old data. This is minutes of the Fed meeting from November 1st and November 2nd, the Federal Open Market Committee meeting. And what I'll say is it's tricky business because there were a couple things that really struck me. So GDP, gross domestic product in the U.S., grew at a moderate pace in the third quarter, which is July, August, September of this year, after 6 months of declines. Consumer price index data is high. Core, so this is PCE, this is personal consumption expenditures, was up 6.2%. That's still very, very high in terms of that kind of data. And then there were some liquidity issues. Foreign asset prices were volatile. Borrowing costs continued to rise. Business loans expanded, but at a slower pace. Credit quality of non-financial corporations showed signs of deterioration, but generally solid overall. So this is regular companies. So they're not hiring, the manufacturers are laying off. And the credit quality is deteriorating a bit. And then there was stuff about like economic conditions, financial conditions. In their discussions of the household sector, participants noted that growth in consumer spending had softened recently. There'd been a reduction in discretionary expenditures, especially among lower and middle income households, whose purchases were shifting towards lower cost options. So, number two, bullish or bearish about the market. So we're a little bearish right now. So what else is going on that was interesting? There was a third data point, which I think is a little bearish. And by the way, I've been talking about this for one particular bank for about 3 months. We are short one bank. I'm not going to tell you what it is because, to be honest, it's not about me telling you about the bank. This is an article about all banks. Steve Goldstein, November 30. Y'all should read this. And so effectively what it says, there's three things. So there's some subtractions you should do about the banks. There's headwinds on banks. Oh, I don't even want to see this. There's a fourth data point. Thank you. Appreciate it. Oh, that's not bad. And maybe one good piece of news, but let's go. So Christopher Whalen, I don't know, from Whalen Global Advisors, but it makes me want to follow him. This is actually pretty cool. So the Federal Reserve says that banks have $2.2 trillion in capital. Okay. 2.2. Let's call that 2,200 billions. That's a lot of capital. I feel safe. I go to sleep at night. The banks are fine. Jeff, they're fine. The banks are fine. All right. But wait. There's book equity and there's tangible equity. If you just look at tangible equity, which is actually things that are real, not like deferred tax assets or goodwill. I love goodwill. If you pay too much for another bank, you get to take the difference and mark it as an asset, goodwill. Who's ever going to pay you back for overpaying? I don't know. So now you take that away and you're at 1.5 trillion. So you're at 1,490 billion. Still a lot. Now, there's this thing called AOCI, Accumulated Other Comprehensive Income. These are losses that a bank would have, but they don't have to tell you. They lose money, but they're going to make it up later. I love this, by the way. I wish I had this. Honey, all of our stocks went down, but don't worry. They're going to go up later. Or, don't worry, I'm not going to sell them. You only lose money when you sell. My wife actually said that to me recently, because before I was in the markets and I was just doing like consulting, I used to say stuff like that. You buy a stock. If you just held it forever, you never lost any money. It's the most ridiculous thing in the world, because when you need the money, you sell it. And when you sell it, you get the market price. So, I don't know. Doesn't sound good to me. So AOCI, the biggest aspect of that one is if you buy a bond that is traded in the market, like a treasury. You buy it, and then the next day, it's worth less. Things happen, right? I buy a bond, it's worth less. I promise I'm going to hold it to maturity. So if you take away AOCI, accumulated other comprehensive income, now the capital's down to $1.25 trillion. So now we've gone from 2.5 to 1.25. We're in half. But what's interesting, and I do this for the banking analysis that I do, but maybe I don't do it quite the same way. You can take the loans on the balance sheets of your bank, and you could mark them to market. So what if they actually sold the loans? You know how when a bank gives you a mortgage, they securitize or they sell the loan? They sell the mortgage. They do it all the time. It's how the mortgage industry works, right? It's what caused the great financial crisis in 2008. But you don't really do that with commercial loans. But let's just assume for a minute that you're a bank and you just need the money, so you have to sell some loans. You mark them to market. The minute you sell one loan, you can mark them all down. In fact, once any bank liquidates a loan portfolio, suddenly everyone's got a clean mark to market. But that's fine. So you got a $1.25 trillion. You lose $1.75 trillion if you mark your loans to market. So now we're down $0.5 trillion. Another almost trillion comes if you were to mark your hold to maturity, U.S. Treasuries, and mortgage-backed securities, and state and municipal securities. Like in Illinois, we have bonds, right? So if you mark all that together, now you're down $1,300 billion of capital. Now, the good news is that the banks don't really have to have capital. The banks can be insolvent. They don't have to be solvent as long as there's not a run on the banks. As long as the federal government and the bank regulators and the media say nice things. Because the minute there's a run on the bank and people start to pull their deposits, then this actually happens. Think about your Bitcoin, your crypto companies. The reason they went bankrupt is because people asked for their money back. As long as nobody needs their money, you're fine. So the banks are riding a wave of ostrich head in the sand. That's how I would say it. So I love this because I have a particular bank in mind that is just attriting away all of its capital. It was one of those rock solid Texas Ranger banks. I mean, Chuck Norris could have been the president of that bank. And now, it's like Gilbert Godfrey is the president of the bank. It's not Chuck Norris anymore. I love Chuck Norris, by the way. Chuck Norris could kill a man just by sending him an email. That's how tough he is. That's how good this bank was. Now, not so good because of these things. So I think everyone ought to read this one. This article is another one of those that is not good, but I love it because it's actually pretty good technically. So then they're saying that there's a trade deficit in goods. I don't care. I don't really care about trade deficits. GDP, the economy grew at an annual 2.9% pace in the third quarter, up from 2.6. That's pretty cool. That's pretty cool. That's good news. So we're going to put that in the good category, the good news category. All right. So we ran our model. What did we find? So by the way, I'm showing you guys some quotes here just to show you where we're at. So the spider's trading at 395.55, which is pretty much flat. The IWM at 182.74, not great. The QQQ 281.10. So let's see if any of these change. 55.74.10. You see some trading. Up a penny. It's not much of a change. CFR, that's Cullen Frost. And pre-market Cullen Frost has 1,600 shares on bid and 1,600 shares on ask. Or bid and offer. Yeah, bid ask. So bid ask is, the spread is about $3. It's about $2.70. That's a huge spread pre-market. So CFR is not going to trade this morning. It's a slow boat to China. What's interesting is CRBP or Corbis Pharmaceutical, which, as you know, is one of our holdings and is a favorite of ours. It's our tragedy. Let's put it that way. It's our tragedy. We've struggled with Corbis for such a long time. We hold a lot of Corbis. Now, it's still less than 1% of the equity of the company, but it's still a pretty big holding. And this morning, Corbis pre-market on 6.3 million shares is up 35.8%. I got to say, that feels pretty good. Now, I think we're going to ride it out. I think this thing goes to like $1, right? And so, but it sure is nice when this thing goes up. I'm not selling. I get diamond hands. I get diamond ring. I get diamond hands. We're not selling. I love the stock. I love the stock at $1. $1. When it goes to $1, maybe we'll do something. Maybe we'll wait till $2. But Corbis at 16.5 cents is still a steal. It's nice to see it finally moving a little. So that is good news for us personally. Because I think I got like 100 shares. And that means I made 4 cents or $4 for every 100 shares. Love it. $4. All right. How are we doing on Cullen Frost? We're short Cullen Frost because we think that the capital cushion for Cullen Frost is poor. Poor capital cushion. Risky. Could be a run on this bank. Could drive it into insolvency. Cullen Frost is in big trouble. But no one seems to notice. No one seems to care. It's trading at the higher end of its 52-week range. This is one of those interesting banks. I just think there's a lot of pain in store for Cullen Frost. So that's where we're at. And we'll be watching. Now, let's take a look at what our model said. See that? I talk a little bit about Corbis and it drops, right? 16.3. But still, that's a nice gain this morning. That's a nice situation. All right, what else we got? So we talked about jobs, and we talked about softness in the economy. Let's talk about some good news. Let's get rid of all these. They're not really that important. We'll keep Corbis up. See, down to 15 cents already. So there's a saying, which is true, especially as you get a little bit older, which is, don't trust a fart. You don't know if it's really a fart or if you can end up shitting your pants. Corbis, to me, don't trust Corbis. Don't trust pre-market. Don't trust any of that. It's just ugly. It's ugly business. It's ugly business. Don't do it. Don't trust it. Never trust a fart. Never trust a pre-market runner in biotech. Because you know what? It wouldn't surprise me if this stock drops to like 10 cents a share by market open. Because it's just what it does. But who knows? I love it. If it wants to go up to $1, I'm all in. But don't trust it. Don't trust it. Don't bet your life savings on it. Right? So we're going to take a look now at the down runs and the up runs. And let's see if anything else comes out. I thought I noticed something last night when I looked. So let's take a look. So this is our down run. So expected market return for risk is 4.7%. You'll notice that's lower than it was like yesterday. Jeffrey, why is it lower? Oh. Corbis is not down. Corbis is up. That's nice. I'm gonna watch that a little bit while we talk here. I'm not selling it. I love it. I love Corbis. I think it's going to $1. I think you're all going to make a ton of money if you bought Corbis with me. Corbis. All right. The all stock variance of the money losing stocks, there's 807 of them, is 8.0 times 10 to the negative 4. It's not bad. The stocks that you would expect to see are your biotechs, of course. Of course, biotechs. But you have Gatos Silver, you have F45 Training Holdings, Telos, Bed Bath & Beyond, Desktop Metal. So you got lots of memes. It's very interesting. Lots of meme stocks. And the way that our model suggests that you play it, there's Alekos, A-L-L-K, and then you can do Alekos with like Gato Silver, maybe with a non-biotech, just to try to diversify a little bit. And there's tons of benefit there for you if you were to short any number of these combinations, right? Short or at least avoid in your portfolio. But from a variance perspective, I thought that was interesting, right? There's not a lot of, let's see what else, I got here. You know, one thing that's important to note is a lot of these stocks, like Gatos Silver, Kodiak Sciences, Alekos, they fell really fast. So as a function of E, they fell 0.1, 0.28, 0.3, and NVTA rose 3.77 times E. So those are really big moves. Those are logarithmic moves. Those are huge moves. A lot of high betas in the money losers. So these things trade like crazy. So you'll see some names here that we've talked about in the past. Carvana. And then you see your Bitcoin miners. Mara, Hut, Riot. So these things move. Carvana, used car sales. They move with the market. Those are crazy moves. So interesting. So interesting. So plenty of stocks to short. The risk of the short stocks is not necessarily going up faster than it was. It's up where it was, but not necessarily faster. So just so you guys know, I'm watching Corbis hit 17 cents a share And I'm wondering to myself, is it real? I've owned the stock over a year. I bought it at $1. Wow, is that crazy? I love it. I'm not selling. You see my hands? They're not clicking mouse keys to sell. This is just watching it and thinking, that's nice. All right, uprun. Oh, by the way, we've got a big meeting today. You guys should know about this. So one of the things we do is we keep up. We're part of the post-quantum cryptography standardization process. We attend the annual meetings. We read all the emails. We're on the mailing list. We keep up. And so it's very interesting. So crystals Kyber, crystals dilithium, Falcon, and Sphinx Plus are the 4 that made it. And 3 of those are lattice. 1 is not lattice. By the way, Sphinx Plus is slow. And Intel's actually got a way to speed it up, which is great. I really appreciate that. And then there was a lot of talk about side channel attacks. And, I try to keep up on that because it's just so fascinating to watch. So Corbis is now up 50%. I don't know about you, but I want to dance I want to dance. But so we're gonna engage all day on cryptography conversations because it's important as quantum computers get larger, get more powerful, that we can protect against them. And it takes years to roll through and update the security. It's not just your website security, but your car communications. It's banking transactions. It's point-to-point communications for corporations, for B2B. Those are all very, very important. And so the PQC Standardization Conference is the official process by which we're going to figure out where the next step is. And so we stay close. We're not PhDs in crypto. This is not necessarily our technical thing. But from a business perspective, we're staying close and we can help clients to think it through. And in fact, if we can help, we do have access to all the right people, we can be very, very helpful. And so we're going to take a look for a minute at that Corbis and we're going to see, people are selling at 19 cents a share, but not that many shares. So you see the price is going up, 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 up. Love it. Corbis through the roof. All right. What else did we see on our uprun? So not a lot of stocks looking weird, which is great. 1,710 profitable tickers. Your all stock variance is 2.6 times 10 to the negative 4, trending slightly lower. Bigger portfolios. So, by the way, lots of leptocurtic stocks. So the best portfolios have 18 stocks. So it's a diversification play. What's interesting is some of these names are lower beta names, less risky. So the stock picks are tending to be like ACI and AB and AFG and APAM, which are kind of like, Brown Brothers, which actually has some news. So that may be just some trading things. And then you have like Qualcomm is still in here, Intuit, Microsoft, Apple, AMD, Amazon, so BX, Earwax, Rocket Companies. What's interesting is it's a mix of stocks that you wouldn't normally put together. And so, yeah, I'm looking at this and I'm thinking you probably want to hold that portfolio, especially if the S&P 500 really isn't moving. This is an interesting mix now. So that's kind of where I'm at. If we look at the one from QQQ, so if we base the whole model run on QQQ, if the world rotated around tech. Then you see the best portfolio actually has 39 stocks. So 18 stocks if your world is the S&P 500, 39 if you're like that younger, more risky QQQ point of view. You got to buy a lot of crap to manage your risk. And so things like Pfizer, things like 1 to 3 year bonds, PNM, which is the New Mexican Public Utility. There's a lot of stuff in there you got to manage. So, all right, thanks for watching. Appreciate it. If you're a Corbis fan, you're watching with me, and you probably cannot believe that stock is hitting 20 cents a share right now. And you are probably thinking to yourself, holy moly, this is amazing. So, all right, thanks very much. We're going to be hitting PQC in about 19 minutes, and good luck in the markets today. Net, risk, the market's starting to behave just a tiny bit better. Our model is still very much risk off, but it's a little less risk off than you'd expect, and things look pretty good. All right, thanks again. You guys take care now. Bye-bye. Oh, if you like the video, hit subscribe, please. Helps us. Maybe hit the like, thumbs up. Drop a comment. We like that. It really helps us. And maybe share the link. We're trying to get the message out there. And the thing that we did not talk about. So we have a new brochure. We have a managed service now. So not only will we run the model for you, but we will manage your money. We have separately managed accounts based on the Chicago Quantum Net Score. That is a tremendous thing. Oh my God, it's a big deal. And then we document much more carefully what you get when you buy one of our runs. And then we have our consulting services. So check out the website. Check it out. It's www.chicagoquantum.com. And on the website, right away, new pictures, right? These are all of our services. New brochure. Check it out. This is our new brochure. This has everything you need to know about how we do business. We would love some new clients, so if you really like the news, come on over. One of our biggest holdings is now up 54%, so we're pretty darn happy today. All right, thanks again. You guys take care now. Bye-bye.